Wednesday, we get the decision about July rate increases, pause or cut. On,
Yes.
on Wednesday, we really get to talk about what is coming. Are we teed up for a September rate cut? But before we talk about all that, I think we should acknowledge where we are. We got a reading on GDP last week, better than expected. We got another inflation reading on Friday showing not increasing, not decreasing, flat.
As expected. As
As
expected.
expected. We have a great jobs number coming out this Friday, or an important jobs number, I should say, coming out Friday. Looking at weekly unemployment, no cause for alarm just yet in the weekly unemployment numbers. We do have the stock market doing something it hasn't done in something like a year and a half, and that is have a 2% decline in a day. That happened last week.
I'll show you a chart on that.
Awesome. So we got to talk
It's a
recession.
very enlightening chart, actually.
Well, let's get this thing started. I don't know where you want to go first. Show us some charts. Talk about Wednesday's Fed decision. I think we are still on opposite sides of that, so the audience will love disagreement. But what say you?
So are you still saying November?
Yeah, I do. But I realize the market's 100% on September.
100%.
That's 100%. So I realize I am drowning. But yeah, I don't see a reason to change. I think a rate cut in September is a mistake, frankly.
That's interesting, because I just attended a webinar by Tom Bowley, and he is ranting and raving that the Fed is waiting too long. They're already too late. Should have done it last month. Should do it this month, but they probably won't.
Yeah, there's a lot of people. I would argue there's more people already saying the Fed is late. There are more people like Tom Bowley, like Mark Zandi, and I could keep running off names that says the Fed. Dude, the number of people that says we should have a July rate cut is higher than the people saying we shouldn't. So that just tells you how maybe how absurd or obstinate I'm being sticking with my November cut.
Yeah, and the issue I have with all of these people saying that, they're seeing the economy weakening, and there's no question that that's happening.
No question.
But the Fed started cutting in May of 2022, and they specifically said we want to see the economy weakening. So it's taken a year and a half for that to actually start to take effect.
Mm-hmm.
So while I can see where they're coming from, but frankly, and Tom Bowley said, oh, the Fed's waited too long. If they wait till September, it's going to be way too long, and then we're going to have a recession. And I felt like sending Tom a note saying, Tom, we're going to have a recession no matter what.
Yeah, exactly. They're part of the cycle, big boy.
They can cut in July and we're still going to have a recession.
Exactly.
They could have cut in June and we're still going to have a recession. There's nothing that's going to stop that. I'll show you why I say that. Yeah. So, I mean, he's going to come out when recession comes and declare victory and say, I told you, that's what I said last year, we're going to have a recession. Just like all these other prognosticators that are.
Yeah. So let me be very clear where I stand, because I love having receipts. I believe they're going to cut in November, but it'll be a bigger than normal cut. It'll be 50, and it'll be acknowledgement that they're late. I believe the rate cut decision in September will be razor thin margin. It will probably be Jerome Powell
25.
going, you know what? Yeah. If there is a cut in September, it's 25.
Yeah, I agree. With that.
And I think Jerome Powell is going to say, you know what? I don't want to be seen as political. I realize that's not a popular statement. I believe, and I've said this for over a year, almost 2 years, Jerome Powell wants to punish Wall Street. Jerome Powell wants to kill the Fed put. And he's going to look at that September date and go, you know what? They expect me to cut. So here's my big FU moment. And, oh, by the way, if things break, I'll just cut by 50 in November. No big deal. That's the playbook I see. I realize I'm out on a very small island all by myself with no water and no food, and
I don't think Powell thinks that way. And Tom Bowley hates Powell. He thinks he does everything wrong. I actually think Powell was late. I've gone through this on this channel before. He was almost a year late raising rates.
Of course.
And that's very clear. And he wants to make up for that. So he doesn't want to be late this time.
Well, hold on.
Which is why he might actually cut in July. So
let's talk about this. No, not yet. Is Jerome Powell sitting here This is what I think Jerome Powell is thinking.
Sitting on this YouTube channel right now.
Yeah, so I think Jerome Powell is going, if I cut too early or I cut too late, which is worse? Because if you cut too early and the animal spirits come back and we have a reignition of inflation, he's going to look like a complete moron, a la Arthur Burns. That's why I am firmly believe he is going to cut one meeting later than he should and cut bigger, because he's going to be the classic firefighter arsonist, right? I'm a firefighter. I create fires. That's what Jerome Powell is going to do.
Interesting. Reminds me of going back to our IT days. Reminds me of one of my customers. And he said, very interesting quote. He said, Dan, we're in IT. We're not in the business of preventing fires. We're in the business of putting out fires.
Yeah.
So, but I disagree. I think Powell.
That's great. I love it. I love disagreement.
Powell will come out next week. He won't cut.
Okay.
But he will make it very clear that he's going to cut in September.
Yeah, and I've actually said that this morning on the Daily Financial News. When Jerome Powell gets in front of that microphone for Q&A, he is either A, going to tailor September cut is coming, or B, he's going to say things like, we're data dependent, we're not there yet, blah, blah, blah. He's going to be more hawkish. The market is going to rip with him being a dove, or it's going to get kicked in the teeth if he's too hawkish.
Yes, that's true. I think Powell is just hoping that one of the questions is the Fed doesn't want to look political, does it? And no, he will then he will have the opportunity to say, well, we thought about that, and we think that quarter point in September before the election and a quarter point in November after the election, that balances out the political side.
We'll see. We'll see. It's going to be Wednesday's going to be a wild day. Wednesday, 2:00 Eastern, 11:00 Pacific. It'll be. I guess here's the question for you: the jobs number comes out Friday. They should have a look at that number, I would think, at this meeting.
Really? They're not supposed to.
Well, I have heard that they get key economic numbers up to a couple of days ahead of time. This is really close. I'm going to guess they have it. I'm going to guess they at least have a draft.
Well, so that whatever they do Wednesday might signal what that number is going to be then.
Oh, I agree with you. That's why I brought it up.
Right.
I agree.
I think the number will come in even from last month, 4.2.
Oh, the unemployment rate. Okay.
Unemployment rate. And I think the September number will come in 4.3 higher.
Okay. Okay. Well, what about the jobs number? The expectation is 190. Do you think again we lose full-time jobs and gain part-time? Do you think it goes sub 100? What do you think about the actual job creation for June?
I frankly don't pay much attention to that.
Okay.
Because
you watch the rate?
I watch the rate because the number, the unemployment, the jobs number.
Yeah, revised.
It gets revised so much, and nobody talks about the revisions after they've come out with the initial one. So
totally agree.
I don't pay much attention to that.
All right. Well, let me ask you this question before we get into the numbers. As I kind of set this up, inflation is flat, falling, not growing, which is good. Job market's still relatively strong. And something we didn't talk about here, GDP came in at 2.8%. Above expectations.
Exactly, which means Powell might not cut in July.
Yeah. How could he cut? How can you cut? How can you cut with a growing market, unemployment not taking the elevator, it's still stuck in the 230s, the weekly number, 233, I think last week, and inflation that's flat. It's not going down, it's flat.
Right.
How can you cut?
I know. I wish Tom Bowley's webinar was interactive.
Yeah. Sometimes I think people have their internal bias about the person, and then everything that person does is wrong.
Yes, absolutely. And there's lots of biases. We all have biases.
Of course.
We have recency bias. We go by, and that's one of the things that he said. And I actually called him on it. He did do an interactive webinar earlier in the week, and he said, you know, with the political situation, we've never seen this before. This is unprecedented. And so I typed in the message, well, we saw this in 1968. So what
Yeah,
exactly?
LBJ, baby. Yeah.
Right. So you can't say it's unprecedented. He
Yeah.
goes, well, yeah, but you know, I was only 7 then. Yeah, but it's still not unprecedented.
Yeah, it's not unprecedented. There is
Just because
data. You can
just
figure out
because you
what
don't
happened.
remember it
Yeah.
doesn't mean it didn't happen. And he goes,
Yeah,
yeah,
folks. Yeah.
but you know, they didn't have an open convention. I said, well, yeah, they did, and they appointed
Yep.
the vice president. Johnson's
Kind of
vice
the same
president.
thing.
Does that sound familiar?
Have you seen this movie before? Yeah. Well, why don't you do me a favor? We've been ranting and raving about what's going on. We disagree on what Powell will do on Wednesday. Great news, we'll know Wednesday. But let's look at some charts. There's a lot of crazy things going on.
Yeah, I got a lot of stuff to cover too today. All right, can you see my
I can.
screen?
Yep.
So for those that are, for those that are interested, this is my website, breakpointtrading.net. Free newsletter is right here. I published it. I got it out late last night because my wife wanted to do stuff on Saturday.
Ah,
Unbelievable.
unbelievable.
So I got it out like almost at midnight last night. But at any rate, we'll look at the newsletter. Actually, let's just do that. IBD actually changed their, it's now uptrend under pressure, cut exposure 40 to 60%. So let's take a look at the newsletter first. This one, I like this cartoon.
Whoops.
Bull.
Yeah, that's not good. That's not going to end well, Bill.
So this is last week, as you said, GDP right here. Expectation was 2%. It went to 2.8.
Yeah, that's a big beat.
Core PCE. I mean, everybody was reporting 2.5, but these things are rounded.
Yeah.
So it was actually closer to 2.6. So it's a little above forecast, but it's equal to last month.
Right. It's flat.
Right. And this is next week. So the FOMC meeting on Wednesday, that's going to be the key for the week. That's going to make it very volatile all week. Yep. And then the jobs number at the end of the week. So here's what I said. GDP came in stronger, so maybe the Fed won't cut rates. PCE came in as expected, so maybe the Fed will cut rates. Don't know, but next week is usually bullish, by the way.
Oh, okay.
So usually we'll go up. I'll talk about this in the next session.
Okay.
But let's actually, let me show you the chart. Give you well, maybe I can blow this up. So small caps is where the rotation has gone to. So these are mostly the aggressive sectors. This is a sector chart compared. This is the S&P up above. This vertical line is the day that the CPI report came out. Okay. Mm-hmm. And these panels below are the small cap sectors versus the large cap sectors. Oh, wow. All right. So when this line is going up, like all of these are, and you can see they all really started right when the CPI report came out. That means small cap sectors are outperforming large cap. Hmm. So this is where the rotation started.
So let me ask you about that, because I've been watching this because it obviously plays with interest rates as well. And
yeah, we'll look at the mortgage rates in a second too.
Yeah. CPI of the 3 inflation readings this month was the most, I guess, dovish, kind of hinting at really getting, inflation under control even more. And that's when this whole thing broke, that the September rate cut moved from, I think we moved from like 75% to 100% rate cut in September because of CPI. And that in stocks, what it basically says is to get out of the Mag 7 or Mag 5 or whatever we have now and start moving into smaller, because smaller companies have been out of the debt market or can't borrow. So is my understanding fair?
That's correct. And the magnificent, I call the Magnificent Seven and Friends.
Friends, okay, makes sense.
Because there's other ones too.
Sure.
Like Netflix isn't even in the Magnificent Seven, for instance. but yes, that's exactly right. All of those big cap technology companies have plenty of cash.
Right.
They don't need to borrow anything.
Mm-hmm.
It's the small caps that are struggling with the high interest rates. So if interest rates are coming down, then they should do better.
Mm-hmm.
So that's exactly what you're seeing with this rotation. So these are the aggressive sectors here. These are the defensive sectors, healthcare, staples, energy, all of them going up from that CPI report. Not all of them getting back above their highs, but all of them moving higher.
Got it.
Every single sector, actually. So that's clearly a move. That's clearly a rotation. So here's the other thing. This is all from my newsletter, by the way. So the other thing I put in there is a comparison of all the sectors. These are the large cap sectors here. But this is what they did end of day Friday. And what you'll notice is that there's a mix. There's a mix of aggressive and defensive. Complexion changed a little bit on Friday. Friday was a bullish day, and actually next week should be a bullish week too. And we'll talk about that in a second, but you can see there's a mix. So you got real estate up here, materials up here, but also technology, consumer discretionary, and communication services. Those are the three main aggressive sectors. But if we go a full week out, now look, every single one of the aggressive sectors are underperforming the S&P. They're below the S&P down here. So that's for the whole week. This is just one day. This is for the whole week. If we then go 1 month out, we see the same thing. All of the aggressive sectors are underperforming for the last month. Everything's moving into defensive. And if we go 6 months out, now all of the aggressive sectors are underperforming, but there's some other ones too, like staples, energy, real estate. They're also underperforming, but all of the aggressive ones are still underperforming. So this rotation has started 6 months ago. It's not something that just started happening last week.
Right.
This has been going on for quite a while. All right.
Mm-hmm.
So, and then we get to the 10-minute chart. So this is just for the week. So I said, even though Friday felt like a pending rally, looking at the full week on a 10-minute chart is enlightening. So after the sell-off on Wednesday, right here, Thursday and Friday, the market just went up and down, basically went sideways.
Oh, wow. Look at that.
Struggling to get back up again. Even though Friday seemed like it was a good day, the market was struggling, couldn't even get back to the Wednesday high. And the sectors, technology was below Monday's high. Financials were better. Discretionary was below Monday. So Monday is a dashed red line right here.
Right.
Communication services, these are the internet stocks, that was below the line. Industrials was above. Healthcare was above. That's a defensive sector. Staples, defensive, was above. Energy, defensive, was above. Utilities was above. Materials was above. So all the defensive sectors, basically from industrials on down, were all above their Monday open. And all of the aggressive sectors were all below their Monday open, except for financials. Financials is the one area that actually is doing really well, and I think might continue to do well.
Okay.
So, so this is the S&P chart, and what I did was I put in what looks to me like could be forming a head and shoulders pattern. So here's the left shoulder here. Here's the head. There's the right shoulder. Can actually make this a little bit bigger.
Oh, I see.
Okay, we're not into the right shoulder yet. Friday was, the recovery day. I was actually talking to my brother, and he said he went to cash because of my newsletter back here, and there are quite a few subscribers on your channel that said that they went to cash last week too.
Yeah, I saw the comments. Yeah,
before this big downdraft. But I said, well, don't feel too bad about it, because the market is basically, and I actually calculated the exact numbers, it's 16 points lower than where it started on July 1st. So
there you go. Yeah.
You can't catch the exact top or the bottom. Yeah. But if this turns out to be a head and shoulders, which means if it goes back up here like it matches this left side here,
Mhm.
and then starts to come back down again and breaks through this neckline, breaks through this. It's actually this diagonal neckline. So this is actually an even stronger head and shoulders because the right side is lower than the left side. If it breaks through, then the target's right here, 5250. You can see that clear resistance level there,
Sure.
then became support. So that's a major area at 5250, and that's the target for this head and shoulders.
Okay.
Now, if it were to come down to that level, you'll notice back over here, there's another little left shoulder right here.
Yep.
So if you take that left shoulder and this is the head, and the way to calculate the target, this is basically called a measured move, is you just take the top of the head down to the neckline, which is right here, and the same distance is where the target is.
Got it.
So if you take the head right there down to the neckline of this one, which is here, then the target is down here at about 48.30, which is right near the 2021 all-time high.
Got it. Okay.
I think it's more likely we're going to hit this level here, right at the 200-day moving average. And I calculated the percentage.
So I don't want that to be missed. Did you just indicate that you think there's a fair amount of pain ahead?
Well, I think the market, well, we'll talk about that in the next session.
Okay. That's
when
fine.
we can compare this year to 2023.
Got it. Okay,
but the key thing here is, and I made a point down here, none of this means the market will fall that far. None of this means that the market will make a head and shoulders.
Right.
It could continue going up and break out of this level here and just keep on going higher.
Yeah, just rip higher. Yeah.
Which then negates,
the Fed cuts rates on Wednesday. That'll blow that out.
Yeah, Wednesday could be the key to all of this. So if Powell comes out with positive statements, that could be what sends the market up here into this right shoulder.
Right.
And
or if he's hawkish.
If he's hawkish, well, it won't even make it up there if he's hawkish. Right. But I don't think he's going to be hawkish. Okay. So the question is, how far up will it go? Will it continue through that, or will it reverse from there? So we'll just have to watch it. None of this means any of this will happen. I'm just pointing out a potential pattern that might be forming. Sure. These are things that I just like to watch. I also like to watch negative divergences, things like that. So
totally get it.
So anyway, I calculated if it did fall all the way down, that would be a 15% decline. All right, and the decline last year, 2023, which I'll show you in the next session, was 12%. So there's no question that it absolutely could happen.
Could happen, yeah.
In fact, if it goes down here to the 200-day moving average, which by that time will be right at about 5,000, then we will be a 12% decline, just like last year.
Okay.
So one other thing I want to show you that I thought was interesting, and you'd probably like to see. That's a rotation. This is the VIX, but credit card debt.
Yeah.
So this is in my newsletter also. You can see that this is 30 to 39 right here, and this is ages 18 to 29. Those are the two highest ones.
Makes sense.
So ages 18 to 39, that demographic are actually breaking to new highs right now, going back to 2020 for their credit card debt. And all age groups are going higher.
Yeah, credit card debt's a problem. Auto loans are a problem. Yep.
Yeah. Yep. So all that are things to keep an eye on.
For sure.
What else? I wanted to show you a couple more things. I have to make notes to make sure I get to everything. The charts. Let's look at PCE for a second.
Sure.
Here's PCE bar chart. So there's what it looks like with CPI. CPI 12-month rate of change is 2.98. They usually round the numbers.
Yep.
Core is 3.28. PCE 12-month rate of change is 5.19. It said 2.6, and I'm not quite sure how that they figure the difference between these, but this is the actual rate of change of PCE.
Got it. Okay.
All right. So PCE is still rising, but kind of leveling off a little bit. Okay. So that's a good thing. And then if we look at the recession watch stuff, unemployment rate, which is coming up next week,
Yep.
So the SOM rule, we had 4.2,
Okay.
4.1, sorry, 4.1 last month.
Yep.
So could be 4.2 the next one. The SOM rule. So I looked at what the SOM rule really says.
Mhm.
It says when the 3-month moving average rises by more than a half a point above the lowest 3-month average over the previous 12 months.
Mm.
Kind of have to think about that, but I went back on the chart and actually calculated, the previous 12 months, what the lowest 3-month average was in that 12-month period.
Mhm.
And July was 3.6. So
Got
if
it.
you add 0.5, you get 4.1.
Right.
And we came in at 4.1.
Okay.
All right. So August goes up to 3.65. If we come in and add half to that, it's 4.15. If we come in at 4.2, then we're above the SOM rule.
Right.
September is now at 3.7. If you add a half to that, it's 4.2. So
Okay.
even if we come in at 4.2 in September or 4.3 in September, either
Right.
way, we're going to be at or above the SOM rule for 3 months in a row.
Mm-hmm.
So that's again the reason why I think that the Fed is going to cut in September, but they're not going to wait.
Yeah, and again, we'll get a clear picture on Wednesday at the press conference for sure.
Right. Here's unemployment claims. So something I just added. So the claims are these dotted lines down here versus the actual unemployment rate, which is this gray line in the background.
Got it.
The gray line is the unemployment rate. The blue line is the Fed rate. And you can see higher for longer for 12 months as of July. And this goes back to 1990.
Nice.
So the point I want to make here is that, and this is a point that Tom Boley said, one of the reasons I put this in here. He said, this is unprecedented that the unemployment claims are going up so much right now that the Fed has to cut. Well, it went
Yeah,
up.
I don't
It
think
went
that's
up
true.
before the last. These are the rate cuts. These vertical blue lines went up 21% there. Went up 30% back here. We're at about 30% right now, so it's not out of line with previous years when the Fed cut.
Yeah.
So I mean, I think it's right in line. I don't think it's extreme by any means. Yeah,
Okay.
but it does imply that the Fed needs to cut. So rate hikes and recessions, as I've said before, after the first rate cut, then it's about 5 to 6 months before a recession happens.
Okay.
So if they cut in July, that means a recession in January. If they cut in September, that means a recession in March, April, beginning of Q2, something like that. If they wait till November, then the recession is out until next June,
Right.
next May or June. And then finally, the inverted yield curve. Again, every time it uninverts, 5 to 6 months later, we get a recession. It is not uninverted yet. However, I put in a 3-year yield curve just to zoom in on it. And that's what it looks like. And you can see the last 4 or 5 months, it has been going up dramatically. You can see the 2-year dropping. See the 2-year dropping down here?
Yep.
That's the 2-year minus the 3-month. And this is the 10-year minus the 2-year up here.
Yeah.
So
very cool.
This one's dropping, this one's going up. So I expect this to probably break out in September, October timeframe. Probably right about the time that Fed has their first cut or shortly thereafter.
Okay.
So if that happens in October, then 5 to 6 months later is Q2 of next year.
Love it.
So these are all recession watch components. None of these have triggered yet. The SOM rule is the one that's the closest, and we'll get more data on that next Friday. And then if the Fed cuts in September, that will be number 2. And then if the inverted yield curve uninverts after the Fed cuts, that will be number 3. So 3 of 3 recession watches will have triggered sometime in September, October timeframe.
Love it.
And the clock then starts 4 to 6 months later. No, I'm not done yet. So hang on.
Okay. All right. My bad.
One other thing that you'll be very interested in.
Oh, yes.
And that is home builders. In fact, before I actually show you this, let me go back over here and we'll look at home builders. This is on my website. See, home improvement retailers went up, but home construction right here.
Okay.
Look at that chart.
That's
So
a pretty one.
this is home builders, basically. You can also use IHB, which is actually an ETF for home. Oh, maybe that's not it. ITB. I don't know. Anyway, there is an ETF for home builders. So which, you know, it's on my website, as everything is. Home builders, yeah, ITB right here.
No,
There it
that's
is.
insurance. I
So
think.
look at that. So
Oh, there it is.
from just
Woo!
about 2 weeks ago.
Damn. Think it. That's home builders saying rate cuts are coming. That's what that says.
Absolutely, no question. And if we look at it on VectorVest, which what you're looking at right here, VectorVest tracks over 9,000 ticker symbols. All right, those are ETFs, contra ETFs, inverse ETFs, leverage ETFs, stocks, everything.
Look at all the home builders on that list.
Yes, exactly. This is the top 40 of 9,000. All right. There, I'm just going to highlight the building ones. Building 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 of them. Oh, there's another one. 11, 12. 12 in the building industry out of 40.
Rate cuts.
12 out of 40.
Rate cuts. Rate cuts.
That is pretty significant. So it already broke out, but those could just continue on higher, especially if they actually come through with rate cuts.
Yeah.
One last thing, because I mentioned mortgage rates. So we'll look at mortgage rates. I just looked at this earlier today. I have all these economic charts right over here. You can see 33-year mortgage rates right down here.
Yep.
You can see how it follows the 10-year yield.
Yep.
So right now it's at 6.78. This is as of Friday. And it's basically just mirroring the 10-year yield. And the 10-year yield, which is right here, is definitely coming down.
Again, rate cuts.
Yep. That's right. Rate cuts. So lower, high, lower, low, lower, lower, low, lower, high, lower, low, lower, high, lower, low, lower, high, another lower low. That is the definition of a downtrend. 10-year.
All right, Jerome Powell, do you have the stones to stand up to this? We're going to find out.
The market is screaming at Jerome Powell. It's time to cut.
I agree with that statement 1,000%.
Yeah.
The market, and again, my belief is Jerome Powell wants to give the middle finger to the market. He's tired of the Fed being led by the market.
I think he'll do that in July.
So you think the July is the middle? That's an interesting twist, actually.
Yeah, I think that July is middle finger. He'll say, you know, we're seeing really positive things, but not quite where we want it yet. But there's enough that probably the next meeting will cut.
If it continues on the current path, blah blah blah. Yeah, he'll have plenty of outs, but it'll be clear. Yeah.
Right.
Okay.
Yeah. By the way, one last thing. This every week on my website, I have a top 10 list right here on the charts page. So top 10 from VectorVest, top 10 from Earnings Beats, which is Tom Bowley, top 10 from Investors Business Daily. And I put the new ones that have just come in. Look where NVIDIA is. The bottom of these two lists. It's been on the top of all three lists for weeks. Oh, right. And it's actually fell off of the Investors Business Daily list.
Interesting.
But see this down here, the top 10 S&P large cap performers.
Yep.
That's what I put in the newsletter. This is last week, NVIDIA #1. And I said, where is NVIDIA? Not even on the list. And look
the AI boom is melting down.
Yeah, look at all the new ones. They're all financial.
Yeah.
In fact, financial makes up big part of my portfolios my dividend portfolios that I do on the very first day of the year.
Right.
And this is how they're tracking right now. So Dividend Aristocrats is up 13%. The Vector Vest scan is up 6.7, and my scan is up over 15% so far. And that's just equity. That does not include dividends.
Right.
So I do that scan at the beginning of the year, first day of the year, and I just let it run. I don't change anything.
I like it. Well, this is a lot of fun. Again, you keep adding stuff to your website. Where should people go if they want to be a part of it?
Just go to breakpointtrading.net right there. Yep. And the free newsletter is in the upper right. And you can sign up down here. If you want to get a reminder, it's the $0, no credit card required. If you want to try it out, there's a 7-day free trial on the 1-month one. You can just cancel before the 7 days. Gives you time to look around. And then for the whole thing, it's $99 a year for everything.
There you go. All righty, folks. Episode number 2 is going to be, is 2024 deja vu with 2023? I look forward to that. Dan, you are amazing. Later.
All right. Yep. Thanks.